series. Well, the WFS Spotlight series. At Quorum, we sponsor market spotlight events in conjunction with the World Financial Symposium, provide a forum for timely topics in the software and technology industry. The WFS is an international organization dedicated to educating technology leaders. Quorum, as many of you know, is the leading global mid-market M&A firm focused on software and technology. We're pleased to have a distinguished panel of industry experts in the energy and clean tech space, as well as insights from the Quorum Research Department. This session will take about 45 minutes and be followed by a Q&A session. I'm John, Vice President of the Quorum Group. Its headquarters is near Seattle, Washington. I'm speaking to you from Houston, Texas, the energy capital of the country. Our agenda. After the comments, we'll have an update from Quorum Research on valuation and trends and relative deals, followed by our guest panelists, who will be introduced in a few minutes. So let's start. Quorum had strong success in this space with recent M&A transactions for clients in mining, petroleum, compliance, clean tech, analytics, and others. Oniqua, with M&A analytics software, sold to ASCO just last month, and Andy, CEO of Oniqua, is one of our panel members today. Probably no other vertical technology market has the same impact on our daily lives, comfort, productivity, and security as the energy sector. A broad range of technologies like to finding, extracting, producing, refining, storing, transport, marketing, and consumption of the world's natural resources. Most view energy policy as a matter of national security. Economies are built, wars are fought over energy supply, and now disputes over the impact of energy consumption on our global environment. At Quorum, think about the energy sector as having 5 distinct segments: scientific engineering and business technology components that reflect the uniqueness of the specific sector. Sectors are carbon heavy and have environmental and climate-related liabilities that power the growth of the renewable and the clean tech segments, perceived to be cleaner and safer. Oil and coal lead these brown fuels in environmental liability. All fossil fuels face a similar carbon challenge. Nuclear has environmental liabilities as well, but these are not carbon derived. Let's take a look at the technology trends that across these sectors that will most influence M&A activity in the coming years. Refers to the first 3 on our list in their own top 10 lists of strategic or disruptive technologies. Can't look at the fact that these technologies are interconnected, don't stand alone in their influence. This is the Internet of Things, the concept of Internet-connected machines that collect data and communicate around for years. We're seeing a change, however, in this enabling technology and its adoption. The industry has many names for this one. GE calls it Industrial Internet, bringing digital intelligence to the physical world of industry. IBM has its Smarter Plant projects, while Cisco champions the Internet of Everything. Utility calls it Smart Grid and Smart Meters. Number 2 list, Big Data. The use of things is contributing to the growth of big data. For example, in the smart grid world of electric utilities, the smart meter is read as often as once every 15 minutes, instead of the additional once per month as we saw in the old world. Third on analytics. Decompose big data into useful information is the job of advanced analytics. 4, compliance. Without escaping the reality of more legislation, more regulations, more control, and more management in operations, health, safety, environment, quality assurance, carbon management, and audit. More and more compliance is the result of automated monitoring, leveraging an Internet of Things. List number 5, cybersecurity. Energy security is national security. Our generation, processing, and transport infrastructure are vulnerable to cyber intrusion, and protection is a critical issue. Power efficiency, lower consumption, our computer structure, operations infrastructure, devices, electronics, and communications is key. And lastly, fuel science. The fuels that are easy and economical to find, produce, and commercialize have been tapped out. Better science and better engineering solutions to exploit the hard stuff and to do so cleanly. Frac is a popular example of game-changing, commercially viable science. Game-changing breakthroughs in battery and photovoltaics remain commercially elusive. So now let's take a quick look at a few fast facts and predictions from our 5 energy sectors. First order, since energy is a vertical where regulation and public policy are significant influences, we'll take a quick look at some policy highlights that will influence M&A. Here, energy independence is the holy grail. However, stability, energy stability, namely stability in supply and stability in pricing, is achievable and meaningful. All of the above energy policy seeks to achieve stability through a blended portfolio of fuel sources, leveraging a wide range of energy technologies. Government funding in renewable and clean tech reflects this policy, but risks camouflaging the commercial viability of some of the emerging technologies and companies while accepting the commercial viability of others. The winners will get sorted out in time, and many bets will get placed. Dependent upon traditional fossil fuels, economic recovery and elsewhere requires available, affordable energy from petroleum and coal. The conundrum we face is that these brown fuels are at the heart of our climate and environmental debate, but lies the technology opportunity. Next, we'll take a deeper look at the petroleum segment. We see general stability in the coming years in the petroleum segment. The price of crude will flex, but remain essentially stable between $80 and $100 per barrel, with limited volatility in the supply. The raw natural gas production has transformed the energy picture in the U.S. With the shale gas boom put America to challenge Saudi Arabia, the world's largest petroleum producer, by the year 2020. The U.S. fuel mix is transitioning to cleaner fuels. Natural gas should surpass oil as the single largest fuel in the energy mix by 2030. Additional brown fuels, coal and oil, become less attractive both politically and economically over that period of time. At the same time, developing countries like China and India need to harness fossil fuels to grow their own economies. This will create conflicts over climate change policy with countries with established economies, moving their dependence away from the brown fuels. Moving forward, users around the world are in the early stages of a transformation that will continue into the next decade. Two impactful technologies are distributed generation and smart grid. Focus here on smart grid as the single most important M&A technology development in the power sector. Power providers are implementing intelligent M2M technologies in the back-end enterprise processes to modernize their operational information systems. These systems result in an enormous volume of data flowing into the utility at an extremely high rate that will grow several orders of magnitude over time. The utility will have to solve data collection, storage, and data analysis challenges and act on new forms of information before they can even get to the point of realizing real returns on their smart grid investments. Valued at up to $24 billion, the smart grid market is projected to grow to $36 billion by 2012. And it's split into 3 components: network infrastructure, software, and the services segments. Over the worldwide market for smart grid analytics is expected to steadily through 2020. With cumulative worldwide spending through 2020 totaling just over $34 billion. So this spending will occur in the Asia-Pacific region, where annual investment will surpass $2.5 billion by 2020. Now, mining sector. Of mining companies in response to slowing demand around the world will drive consolidation of technology providers as well. We've seen recently with the acquisitions of Ivara, and Oniqua. An high-profile merger among the miners is Glencoe-Xstrata. Glencoe has just gained European regulatory approval for its $33 billion takeover of Xstrata, creating a mining giant with a market cap in the range of $80 billion. BHP Billiton, still the world's largest miner, is set to buy Petrohawk for $12 billion in cash as it puts into shale natural gas. This carries a 65% premium for Petrohawk, and the deal is the latest example in the Roehr shale natural gas arena. These deals come at a difficult time for the mining industry. A slowdown in the fast-growing emerging economies like China and India hit commodity prices. We see the Glencoe-Xstrata deal leading to a new round of consolidation as miners adjust to the economic reality of lower prices and lower demand. Yet operators at the same time have become hot commodities over the last year, with Marathon and Royal Dutch Shell among the big oil and gas companies with billions of dollars for deals in the sector. For larger consumers of technology typically means less supplier diversity and more standardization of those technology solutions. This will make it harder for innovative emerging technologies to break through commercial viability. For mitigating the consolidation impacts, miners quest operational efficiencies, challenge of mine remoteness, and the shortage of knowledge workers will continue to drive new technology adoption. Op efficiencies are key, driving impressive capital spending commitments by these miners, particularly in the area of energy conservation, renewable energy technologies, to lower operating costs and mitigate their carbon liabilities. Clean tech and renewable sectors, price and supply volatility of traditional petroleum have typically driven cycles in renewable and clean tech. The sector has struggled with viability on its own merits. Add in today's threat of climate change, which won't go away, and we are closer to sustainable economics in this segment than ever before. This accelerates the funding, commercialization, and adoption of clean, efficient, and renewable technologies into a meaningful role in the world fuel mix. Most in this sector is robust investment. Obama's all-above energy policy for energy diversity and economic recovery is funneling funding into renewables to accelerate their commercial viability. The DOE has funded over 1,300 companies in the renewable energy space, with fewer than 1% going bankrupt. There will still be churn in the winners and losers in the transition from innovators to early adopters with consolidation and many early-to-market technology companies. In California, we're seeing the implementation of a carbon tax, and this projects to a $1 billion of earnings in carbon tax compliance revenue in 2013 alone. So let carbon tax or cap-and-trade legislation to gain momentum, and not to drive the pivot away from brown fuels towards efficiency and renewables. The tax revenues will prove irresistible even for a deeply divided political landscape. Okay, the government hopes its proposed new energy bill legislation will provide sufficient clarity for investors to unlock $175 billion for new infrastructure in order to keep the lights on. This is setting a base price for low-carbon energy, but does delay until 2016 any decision on a commitment to decarbonize the country's electric supply. In Australia, the Clean Energy Act of 2011 means that oil and gas production and processing facilities will have measurement, compliance, and mitigation liability. As a consequence, this legislation will ensure that companies have a clear carbon strategy for the lowest cost of compliance, including accurate emissions measurement systems, reliable emissions forecasting, transparent carbon pass-through models, and a suite of emissions reduction initiatives ready for launch. So with that, I'd like to move to an update from Jason, research analyst for Quorum, to give us some perspective on valuations and recent deal activity in the energy sector. Jason, to you.
High-level overview. At Quorum, we regularly track 6 software markets and their related subsectors. This data allows for quick market identification so owners, founders, executives, and other decision makers can assess where they fit in the overall scheme and identify related M&A activity, actions, market insight, which are most relevant to them. In this section, I am going to report on the state of science related to the energy topography described by Jeff, which falls into the energy and environmental subsector of Quorum's vertical Apple Software Market Index. As many know, the broad market for energy-related M&A, including oil and gas, clean tech, mining, and power, has been vibrant since 2011, despite ongoing economic uncertainty. In energy alone, KPMG counted a total of 591 deals valued at more than $51 billion in 2011. In 2012, 150 transactions totaling $9 billion have been announced. Of the blockbuster transactions being reported on in the press are just companies trading production assets. This activity has had a great effect on the underlying software and technology M&A. Additionally, M&A in the subsector has been stimulated by political tidings in Washington, D.C. Mr. Obama's energy policy is an all-of-the-above approach. He favors government investment in green companies to stimulate new tech. $9 billion of Mr. Obama's much maligned and much applauded stimulus bill was dedicated to stimulate green energy. Scaramellino may have failed in spectacular fashion, but the program may do wonders in advancing innovation, a key driver of M&A in the industry. Elsewhere, the continuation of Obama's environmental policies, the effect of stimulating innovation in clean coal, fuel efficiency in automobiles, and natural gas. What does it mean for valuations of petroleum, power, mining, renewable, and clean tech software companies? Compare valuations of the energy subsector to core vertical application market and the aggregate market valuations for software companies as a whole, while reviewing the top strategic acquirers of the last year. Finally, we'll discuss acquisition strategies of top strategic buyers and notable energy transactions over the last 24 months. In January, many of you will recall, Quorum forecast a banner year for tech M&A, and this held mostly true, with EBITDA and sales multiples seeing sustained highs of about 10 to 11x and 2 to 2.3x respectively. These multiples are being driven by a cadre of strategic and financial buyers flush with cash and some truly disruptive technologies that are beginning to take hold. In particular, the mega trends like big data analytics, cloud computing, and connected devices have been innovation and generate incredible amounts of M&A across all sectors. In the subsector, on top of that, are renewed drives for efficiency and emerging technology, all of which is creating the perfect conditions for software M&A. As a result, valuation in Quorum's energy and sustainability subsector, which tracks the performance of companies like IHS, and Schlumberger, have consistently performed among the best of the 26 subsectors followed by Quorum. Current multiples are off somewhat from the high seen in August of this year. At 12 times EBITDA and 2.5 times sales, they still compare favorably to the broader vertical application software market multiples, which have yo-yoed between 2.5 and 10.5 times EBITDA and 2 to 2.3 times sales over the last 10 months. In this index, the Quorum Group has tracked nearly 100 energy and clean tech software transactions over the last 2 years, and the top acquirers are those many would suspect, including IHS and GE. However, there is a very healthy and diverse cohort of companies who have conducted 2 to 4 transactions over the last 2 years as well. IHS acquisitions are necessary to sustain its technical information services for the oil and gas industries. These are content deals. They tend to stay small. However, in 2011, IHS shelled out $500 million in its largest acquisition to date for Seismic Microtechnology, a market-leading geoscience software company, as it races to provide its oil and gas information clients with analytical tools. Unsurprisingly, GE has long been a top energy and clean tech software acquirer. Over 2 years, it has brought such companies through its various subsidiaries around the world. In addition to manufacturing the turbines that convert wind into energy and fuel-efficient jet engines, GE sells services and software to utilities all over the world. Its Intelligent Platforms division is focused on leveraging the Internet of Things, or the Industrial Internet as GE calls it, to meet rising energy demands all over the world. A report GE issued Monday, the ability of devices to communicate status updates collected from affordable sensors over an industrial internet to other people and machines can mean big savings for the power and oil and gas industries. GE estimates that the power sector spent more than $250 billion last year on fuel gas and will likely spend $440 billion in 2020. If the gains from advanced asset monitoring and process diagnostics tied to improved integration of the natural gas and power goods could reduce cumulative fuel spending by $66 billion over 15 years. It built its core industrial internet offering for the energy sector by acquiring SmartSignal and CSense Systems in 2011. By combining SmartSignal's remote monitoring and diagnostic solutions with CSense's software, GE claims to have a real-time asset monitoring and diagnostics platform for enabling more efficient operations. In 2011, Schneider responded to GE's acquisitions by picking up Talvent, a provider of real-time management software for $1.6 billion at 2 times revenue. Other things, Schneider also picked up Summit Energy, the energy procurement and sustainability company, in 2011 for $270 million, and to shore up its position in the energy management market. Which started out as an iron and steel manufacturer back in the 1800s, was one of the top overall software and technology acquirers in 2011. It's a prime example of a large corporation using acquisitions to transform itself and pursue new growth markets. Our focus on energy prices has led to increased integration between financial trading and energy and utility industries. This has led to some intense consolidation amongst the energy, logistics, and commodity management software providers. Over 24 months, I counted at least 7 deals in this space, the most recent being ASCO's purchase of Oniqua, who was represented by Quorum in this transaction earlier this month. With the evolution of cap-and-trade policies, as well as increasing financial regulations, I expect innovative energy and risk management software vendors to continue to be ripe acquisition targets, especially for private equity firms who are keen on the marriage of the finance and energy worlds. Private firms, along with their venture capital brethren, were the first investors to champion clean tech. Today, the group remains, by and large, committed to this sector. According to SAM, the Zurich-based sustainable investment boutique, the investment community has nearly $18 million in VC funds and $23 billion in expansion-stage capital, over 4,000 deals since 2000. PE is broad and deep, with and specialty funds making investments across the clean tech, energy, oil and gas, and utilities landscape. With investments in P2 Energy, Vista Equity is among the leading firms in the energy software. The company to its portfolio in June of 2008, Vista has helped P2 acquire 4 or 5 companies to build a true platform play. As national companies are just beginning to grasp the strategic value associated with clean tech, we expect them to fuel M&A activity and healthy exits for tech vanguard PE funds like Doughty Hanson, Paula, GMI, Kyle, and all the Norwegian investment coming out of the North Sea. So that's a recap of the last 24 months. For continued coverage of all software tech M&A, be sure to tune in to Quorum's monthly webinars. Back to you, Jeff.
Jay, thank you. Lots of interesting M&A activity. Let's not talk Vista's involvement with Ventex and their acquisition of Mincom before they sold that proposition off to ABB. Very pleased to get our industry panelists into the conversation. We've got a great group gathered today. We're going to talk about related developments within their specific sectors. We have 2 recent sellers in the group, and I'm anxious to hear their deal-related insights as well. We're Andy Roehr. Andy is joining us from Houston, where he is Managing Director in PwC's Global Utilities practice. You see Andy's bio on the screen. Andy, over to you for some insights into the power sector.
Thank you, Jeff. So I appreciate everybody's getting on this morning. I'll spend a few minutes here looking at the power sector. Power sector, really smart grid, which is where I work, is an interesting spot for 2 reasons. One is it is an area of tremendous change and innovation, obviously, in the U.S. A lot of attention being paid to it after recent events. It's also a source of investment globally. Interestingly enough, though, that means that the vast majority of spend on both gear and on systems seems to be coming out of Asia-Pacific, Pacific region, and not out of the U.S., where a lot of it's been led to date, mostly on the back of ERA funding. So what we're seeing a lot is a tremendous amount of innovation in the U.S., very creative companies stepping up to solve problems, suddenly finding that the vast majority of their market in the today to 2016, 2020 range is probably going to be international. So it's raising some interesting issues, I think, for a number of startups that we see. The other interesting things that are going on, in addition to the kind of globalization of the market for services and software and solutions, is the focal points. We have, as was alluded to before, talked about alternative gen or clean tech, the move away from brown fuels. Sounds interesting, but the more intermittent renewables you put into the grid, the less stable the grid is. There's a need for true real-time grid management and optimization solutions, which today are, I'll say, 100% effective. So tremendous opportunity to go in and solve that problem. All the other trend we're seeing is towards distributed generation. Move away from large centralized generation facilities, probably best typified today by a move towards what are called microgrids. These are the isolation or islanding of commercial and industrial areas, the implementation of often space turbines with combined heat and power, often backstopped with renewables, solar, wind turbines, etc. So more and more of this represents some very interesting challenges for the industry both in terms of the ability to manage those. Somebody's going to have to. There'll be solutions required for that. The other one is the implications for the loss of that load on the general grid, on the general power grid. That power grid will then be a backstop as opposed to a primary resource, and that's going to create some instability and management issues in real-time supply-demand balancing for utilities that I think is going to be pretty profound overall. In this area, we've seen some interesting transactions going on, and I'll just sort of corroborate some of the multiples, but three particularly in the smart grid space. One is the acquisition of eMeter by Siemens, the acquisition of Elster, which is a meter manufacturer, by Melrose out of the UK, and the acquisition of Ecologics Analytics by L&G out of Switzerland. L&G was then acquired by Toshiba. What's interesting about all three of these is we have, for the most part, U.S.-based firms here up and acquired by global players not located in the United States. So just like my earlier point about the true globalization of this and the opportunity to build something here in the U.S., build a U.S. customer base, and then realize that value through a global market participation, I think is important. So, with my watch, be respectful of Jeff's time here. So, a couple of predictions I think in this space. One is we think we're going to continue to see a continued move towards alternative generation. I don't know from a policy perspective what's going to take place down in Washington. We are kind of at this point, but I think we're going to continue to see additional interest in alternative generation. A couple of reasons, not the least of which is even though it might be more expensive to acquire on a per kilowatt basis, we're seeing interest in the predictability of the long-term cost of energy. People feel a little bit at risk from the vagaries of gas and things like that. So that's one. Number two, going on the heels of Sandy and some of the other discussions, we expect there's going to have to be a tremendous investment made, hopefully, here in the U.S. in the power grid. This will have some real heavy impacts on, obviously, on rates. So we see people looking at how to participate less in the grid and more their own, again, to shield themselves from cost increases to their business, most coming from changes in the regulation and rate making areas. Third one is we believe that globally, although gas is interesting here, and we talked about fracking, when it's down to it, we think people are going to look for more distributed generation, more control, and we're going to piggyback that on the back of energy efficiency, the ability to control demand selectively. So those we see as kind of the big trends right now, and I'll stop my comments there, and we can come back with Q&A later. So Jeff, back to you.
Thank you. Appreciate that. Fascinating insights. Let's move to Tom Scaramellino. Tom is coming to us from New York City. Tom is Senior VP at C3 Energy and the founder of Efficiency 2.0, which he sold to C3 earlier this year. Tom?
Good afternoon, everyone. As Jeff mentioned, my name is Tom Scaramellino. I was previously the founder and CEO of a customer engagement and energy efficiency software company called that recently sold in April to a company called C3. I'll just briefly describe the activities that the companies engage in because I think it's relevant to some of the discussions that and threads that we've mentioned here. In 2005-2006, states began enacting laws that are often referred to as energy efficiency portfolio standards and energy efficiency resource standards. Essentially, they place a mandate, a series of carrots and sticks, depending on the state you're looking at, for utilities to actually reduce their energy sales year over year relative to a previous baseline. So if you look at our customers, for instance, Pacific Gas and Electric, they're now required, I believe, to reduce the sales by around 4% relative to what they sold in 2009. This type of pressure requires that utilities begin thinking about customers in a much more sophisticated way. When you combine that with some investments and requirements around smart grid infrastructure, you end up looking at an environment where utilities are in a pretty disruptive position, whereas previously the business models looked pretty straightforward. Get customers their bills, keep the power lines up, and you want to sell as much energy as possible to create profit for your shareholders. Utilities over the past few years have been placed in an awkward position, based on their historical business models. They really need to start engaging customers in meaningful ways. And so Efficiency 2.0 was founded on the principle that smart grid infrastructure begins to develop in a much more rapid and scale manner. As energy efficiency goals begin to increase in states across the country, utilities were going to have to transform the way they engage with customers, not just around harnessing large data sets, related to taking interval data in from smart meter communications, but also in terms of being able to verify that these customers are generating meaningful energy reduction. So if you look on the smart grid side, for instance, go back to PG&E just as another example, they got through, they probably have the largest implementation of smart meters to date in this country, and they got through a proposal in the California Public Utility Commission where there was about a $2.3 billion expenditure related to their smart grid rollout, and about $900 million of that $2.3 billion expenditure is expected to be recouped in terms of, based upon the actual savings that consumers and businesses in the territory are able to generate as a result of this updated grid infrastructure and the enhanced data and transparency that they're able to access. That $900 million number is a very tall order. And what we've seen is a number of areas come into play. You saw early on in the market this home area networking, being able to control devices in the home. Many utilities ran pilots with those. Some were quite successful. Some were abysmal failures. There was a number of challenges related to those. But by and large, most of them suffer from a lack of consumer interest and adoption. And so Efficiency 2.0, we focused our efforts on doing a ton of research about how consumers think about energy, and we came to a rather discouraging conclusion for the industry, which is that customers really don't care about energy information. Smart meter implementations to date, for instance, everyone talks about big data and how we're able to access all this information, but frankly, most smart meter implementations to date are only displaying day-behind data. So most consumers participating in these smart meter pilots, for instance, are able to see how much energy they were using at 2 p.m. yesterday, but not today. And frankly, many consumers don't find that all that interesting. So at Efficiency 2.0, we pioneered a concept for residential and small business customers of utilities where we would reward them for their energy savings. Based on how much energy they save, that's base load reductions for energy efficiency, or peak load for shifting or shaving load during times when it's expensive to generate the energy. We give customers points based on those reductions, and with those points they can go get great discounts at their favorite national and local stores. So if you reduce your bill by 50 kilowatt hours in an Efficiency 2.0 program, you can get $10 off at Bed Bath & Beyond, for instance. And we engage a lot of next-generation marketing and algorithmic capabilities that enable us to target these types of offers in very specific ways to customers. And so we realized very quickly that one of the most effective ways to generate consumer engagement around smart grid infrastructure is to create this concept of rewarding customers with immediate financial gratification, because energy data seems somewhat opaque and uninteresting to them. Efficiency 2.0 beginning in 2009 with some of the largest utilities in the country. We did achieve a certain amount of scale. We raised about $10 million, had an office here of a little over 35 employees. And we decided in April to work with a company called C3. C3 was also founded in 2009. C3's primary focus was on delivering software solutions both to utilities and to large enterprises to help large customers, industrial customers, and large commercial organizations characterize their energy footprint, find the best opportunities to better manage it, and obviously increase the transparency of their data and their communications across the organization related to energy expenditures. C3 was founded by a group of executives that came out of Siebel Systems, including Tom Siebel, and so they really wanted to focus on bringing the concept of big data to life for utilities by creating much more interesting analytics about customers that helps them to engage them to hit some of these energy efficiency and peak shaving and shifting goals. Now, the rationale behind our merger, I'll talk about that briefly here, and then I want to make a comment that kind of goes back to some of these questions around predictions about the smart grid. The rationale behind our merger was really focused on things. When we started Efficiency 2.0 back in 2009, when we were looking at the competitive procurement process at utilities, it was incredibly siloed. Most utilities will have a number of departments that face customers. They'll have a marketing department, they'll have a demand response department, they'll have a smart grid department, which actually is separate oftentimes from demand response, an energy efficiency department. And what we found to be interesting is that the director of energy efficiency, in many cases, hardly interacted with the director of demand response or the director of marketing. So we found an organization at most major IOUs in this country that was very siloed. And we noticed over the past few years that these departments are beginning to talk with one another and work together in much more sophisticated ways. We're seeing RFPs coming out from utilities that are cross-department, which we never saw back in 2009. And I think a lot of that speaks to this notion, and I think it really plays out well in the vendor community too, and speaks to sort of a larger trend justifying some of these acquisitions that were just mentioned, is the sense that these departments are beginning to get the sense that investing in smart grid infrastructure, finding the return, hitting the energy efficiency goals, really requires a comprehensive look at all of the offerings that they can provide to customers and all of the services they need. This is one of the reasons why I think you're seeing companies that focus on smart meters or smart grid communications, putting routers on telephone poles, those types of folks, are beginning to look at MDM companies in a meaningful way, where previously they never had any interest in MDM. You're finding these same companies looking at consumer engagement and marketing firms. One of our closest partners is a company that was just mentioned, Itron. And all of these folks like Itron and Silver Spring that are now going into these bids for these very large smart grid infrastructure projects, they need to show utilities what consumer value looks like, because utilities are required to demonstrate that to regulators. So you're seeing areas that were previously purchased in silos, from MDM, back office software, hardware and devices in the home and the business, actual grid infrastructure and meter infrastructure. All of these things are now beginning to, utilities are now beginning to take a more comprehensive look at them. And one of the things that I find interesting about this space, and one of the trends I'm seeing that I think does have a great impact on the vendor community, is this concept of utilities beginning to consolidate. Recently we saw Duke and Progress merge to create the largest utility in the country. Northeast Utilities merged with NSTAR. And there's a couple sort of longer-term rationales for why these big mergers make sense, but I think I was at the Itron user conference a couple weeks ago, and a gentleman named Lloyd Yates, who's an EVP at Duke Energy, I think expressed it very well. Look at the supply side of the grid, and many of these coal plants which were built in the late 60s and early 70s, and many of which are 10 to 20 years beyond their expected lifetime. Look at the environmental movement's success in preventing some new coal construction. The Sierra Club, for instance, has been incredibly effective at preventing utilities in many key states from developing new coal generation. You begin to get a sense that utilities are going to need very large balance sheets to begin to invest in some of the generation capabilities, particularly nuclear, to enable them to meet some of our energy demand requirements going forward. And so, Lloyd's view on this, which I think is right, was that although there might be a near-term hiatus in consolidation among large IOUs, because you saw some of these issues with Duke and Progress, Northeast Utilities and NSTAR went through a variety of regulatory hurdles in Connecticut and Massachusetts that created a ton of additional transaction costs for their deal. So there are certainly some pretty big hiccups in the road. But over the long term, we should expect to see utilities begin to consolidate much more aggressively. And that, I think you're going to begin to see a trend towards vendor consolidation as well. You're going to begin to see smart meter companies recognize the value of consumer engagement software. You're going to begin to see hardware companies in the home or business recognize that they actually need to get customers to adopt this software. And to do so, you need sophisticated marketing apparatuses. So that's where Efficiency 2.0 and C3 come in. And the rationale behind the merger was really quite simple. We each had customers who said, look, love what you guys are doing for us. We were working primarily in the residential and small business space, C3 in the large commercial space. And they said, look, we really prefer just to buy all this from one vendor. If you look at most utility IT departments, they're substantially outdated, largely because many utilities don't get cost recovery for their IT investments, or if they do, the rate of return isn't as attractive as it is in other areas where they can invest. So there seems to be this pervasive issue of underinvestment in IT infrastructure at large utilities. And so when a utility hires a vendor for a specific project, there's substantial upfront and even ongoing costs for them to continue to work with that vendor. And so the rationale behind our merger was to say we want to be the first vendor that's capable of providing customer engagement software and marketing platforms for residential, small business, and large commercial customers, for all three customer classes that large IOUs serve. And I think that there's a powerful justification for that in the sense that we can dramatically reduce the upfront and ongoing costs related to investing in software and services that help maximize the value of smart grid and energy efficiency implementations. So that was our rationale for merging. The company works with some of the largest utilities in the country, including, as I mentioned, Pacific Gas and Electric, Southern California Edison, Entergy down south, Commonwealth Edison, Detroit Edison. So we've got a nice portfolio of, I'd say, probably about half of the largest 25 utilities in the country. We also sell directly to enterprises like Dow Chemical, for instance, who has a $1 billion energy footprint. And so one of the things that we're focused on here is helping to solve this problem of updated IT infrastructure for utilities. And so I'll use PG&E as an example. And I think this is actually a major hurdle to really, yep. Hello?
Yep.
I think that,
yes, we can hear you.
so I was just saying that with a company like PG&E, we're pulling about 9 terabytes of data from PG&E right now, and we're pulling it from 19 disparate data sources. So when you look at that company, there's about 8 different areas in which they maintain billing data from customers. And so that kind of a problem is something that historically you'd bring in an IBM or an Accenture or an Oracle, and utilities are still relying on those folks to a significant extent. But what we lack is the ability to see all of that data in one place in order to maximize the value of it. And I think what you're going to begin to see is vendors who focus on the hardware side of the business begin to roll in some much more sophisticated software to enable them not only to increase their margins, get into a much higher margin business, but also to be able to meet this need directly with utilities. And so that's probably my biggest prediction for the business, is that through all the fits and starts of smart grid investment and the difficulty of a utility sales cycle, is that you'll begin to see utilities consolidate, which will ultimately lead to much greater vendor consolidation across the MDM, the in-home hardware, in-business hardware, as well as the meter and communications infrastructure. So I'll stop there, but that's my 2 cents on where I think the market's headed.
Tom, you appreciate that. Especially like the concept of the development of an integrated turnkey vendor that helps their customers create demand for the customer products as well as the vendor's products. Interesting idea. Pivot a bit sideways to Andy Hill and Oniqua. Andy, CEO and founder of Oniqua. He comes to us from Canberra, Australia. Andy has recently sold his MR analytics company to ASCO, a Hanson-backed energy services firm out of the UK. And to give us some insights into your energy mining and utility, mine and utility sector, with your energy solution.
Yes, and good afternoon, everybody. A large part of Oniqua's business started out in the mining industry. More recently, we also focused on oil and gas, utilities, and transportation. So what Oniqua provides is MRO, maintenance, repair, and operation analytics for asset-intensive organizations. What I'd like to do just in next minute is talk a little bit about what we're seeing in the mining world, and how that relates to particularly the uptake in analytics, and also just give you a little bit of background on our recent deal with ASCO. So as you know, the mining world is typically driven by commodity cycles, but in recent years there's been a lot of talk about what they call the super cycle. So driven primarily by the urbanization of China, the demand forecast for commodities has, I guess, led the mining world to believe that they were in a super cycle, which would last pretty well indefinitely. Sadly, that all came to a halt about 3 months ago, and the mining companies pretty much put both feet on the brakes as the prices came off, particularly in iron ore and coal. What we're seeing is that whilst the mining companies have reacted very sharply, the sort of longer-term forecasts show that there will very much be a lot of volume growth in the future, but not the sort of pricing growth that was driving the super cycle. So effectively, for the mining companies, their margins have been squeezed. In the mining world, typically what happens is they yo-yo from a sense of production is king to going in the opposite direction where costs are everything. And so they look at technologies that in good times help them achieve their product targets. So they're very, very much looking into analytics on things like reliability and outbound supply chain. But then when the tougher times come, they're very much looking to be lean. So they're looking at inbound supply chain, anything that will help them to reduce costs. So for us, that's been quite a good environment. Mining in the past has been quite a conservative sector in terms of their investment in technology, and probably a slow adopter of technologies. But we've driven with the cycle. We've seen a little bit more forward thinking. I think initiatives such as Mine of the Future, where many companies have started to adopt technology from other industries, and particularly in terms of remote sensing and remote mining are starting to be much more advanced. So the uptake in analytics, whilst slower in mining than other sectors, has been quite healthy. For Oniqua, the timing has been quite good. With the help of Jeff and the rest of the Quorum team, we closed a investment from ASCO. ASCO is a strategic investor. They're probably the preeminent oil and gas logistics company in the world, based in Aberdeen in the UK, but with operations around the world. ASCO was themselves recently acquired by Daddy Hanson, a major private equity firm out of London. And ASCO is trying to move up value chain to provide more services to their customers. And so Oniqua's optimization and analytics technology and services were very attractive to ASCO to help them do that. For us as software vendors, probably going back about 12 months ago, we became aware that there was a lot of activity happening. A window was opening, and a concern for us was that potential consolidation could change the landscape for us dramatically, and we were keen to find a strategic investor who could provide us with additional financial backing, but also, in the case of ASCO, an ideal channel to market. So ASCO, through their relationships with the big oil and gas companies around the world, we believe will be an excellent channel for us to bring our analytics technology into the oil and gas space, and hopefully quite quickly achieve the sort of success Oniqua's achieved in mining, where we work with 8 out of the top 10 mining companies. We're looking to do the same sort of thing in oil and gas in quite a short time frame. So with that, I'll conclude my remarks, and back to you, Jeff.
Yeah, thank you very much. We appreciate those insights. What's interesting is that both you and Tom exist in a market where there's been some major consolidation, buyers or the customers in those markets. Few minutes left for questions. Some have come in from our audience. Let me take a little bit of time for a few questions. I know we're running. I don't want to run too long here. But the first question relates to timing the M&A marketplace and taking your cues or signals from consolidations amongst the customer base. Both Tom has mentioned the Duke Progress merger. Andy, I talked about Glencoe and Xstrata. When you looked at your own business and attempted to time the marketplace, how influential were these signals to your own decision to seek a strategic partner, or were your motivations more internally driven rather than externally driven, as I've mentioned? So let's put Tom on that one. Tom?
Sure. Well, I think that, one interesting things about the utility space historically when you're looking at the customer-facing side of the business is that because they've operated in silos, the buyer and the actual holder of the budget that you're seeking is often a mid-level manager. It's a director of energy efficiency or director of smart grid. Historically, the executives haven't really influenced those purchasing decisions in any kind of meaningful way, which is why you see so many vendors gaining different pieces of the landscape, but nobody really coming out as a clear winner. I think that as utilities begin to consolidate more, you're certainly going to see them streamlining their operations and centralizing a lot of their functions, whether it's IT or shared services. And so with that, you're going to see them make some longer-term bets on vendors in the space, and that applies across meters, grid infrastructure, consumer and customer-facing software, MDM tools. And because of that, I think with utilities consolidating, it becomes more incumbent upon vendors to develop executive relationships early on, to really cultivate those relationships and view your utility customer as a long-term partner as opposed to just a client. And so when a small company like ours was thinking about how we really attack the space and prepare for that kind of a land grab, so to speak, it becomes incumbent upon you to find a strategic partner that can develop those executive level relationships. That's kind of a very strong external motivation for us in our partnership, and it's a motivation that we continue to embrace with our partnerships with folks like a very close relationship with SAIC, with ICF, which is a very large consulting company that does a lot of energy efficiency program administration, as I mentioned with Itron. And so being able to create a strategic partnership environment where you can sell first at the executive level and have that trickle down to a number of different operating companies, you can really accelerate your sales cycle. And if you miss out on that, and if you don't develop those executive relationships, it can be very difficult for you to catch up later in the game. So that's what I'll say about that.
Thank you. Andy, any thoughts on the question?
Yeah, I think obviously, go out saying timing is everything, and it's something that we thought very hard about before our recent transaction. We had been in the market in 2008, 2009, looking for a strategic buyer, but obviously withdrew after the financial crisis. The second time around, I think one of the things we're aware of is that by the time you see the announcements in the market, probably the cycle is at least 6 or 12 months old. So I guess you need to be anticipating what may be happening in the M&A cycle and get out in front of that if you possibly can. So I think be interested in your thoughts, Jeff, but perhaps that's, whilst that cycle continues to be quite strong, still quite a lot of M&A activity, we certainly understood that wouldn't happen forever, and it was important that we weren't, if you like, the last one standing in the market.
Echo your thoughts on that. It's important to understand the timing and risk. The serious risk is waiting too long for something exit rather than moving too early. Buyer appetites can get satiated pretty quickly in a rapidly consolidating marketplace. I think we have time for one last question. Let me direct this to Andy Roehr. Andy, the question came in Superstorm Sandy told us about the vulnerability of our power infrastructure here in the States?
Sandy is the latest in a list, from Katrina to Ike here in Houston to the several storms through New England last year. It tells us a couple of things. One is that we are trying to build a 21st century economy on a 19th century power grid, and that needs to change. I think the alarming part of that is the level of reinvestment, and you're starting to see numbers come out, billions, the level of reinvestment that will be required. I think the caution for the industry is to rethink what we're doing. So we deliver power today is generating stations delivered through incredibly complex networks, power to your house or my business. I think it's going to change because the level of vulnerability inherent in that infrastructure to natural disaster, national security interference, and other things is incredibly large. That was built for a time with a different set of capital markets, with a very different set of consumption behaviors, and very different technologies. So I think the bottom line is we should rethink energy delivery in the United States entirely. Might be, frankly, that we won't. We need to get people up and running, obviously, and when we pack what we have. And it's very hard when the lights are on to have the conversation about, hey, let's add 30 or 50% to the electric rate structure in New England. In some places, they're already paying 12 or 14 cents a kilowatt on the residential side. But let's jack that up by 50% in order to put in a new infrastructure. That's going to be a very hard sell. Flip it is, if you don't, will you have the economic viability to withstand, and ultimately will companies and individuals vote with their feet those areas of high vulnerability and move to places that have made those infrastructure investments, or even at that point anyway, less likely to be interfered with. So I think it's going to be an interesting dance to watch for the next 6 months. We don't have a lot of money here in the United States. People are looking to the Fed to write the checks. We all know the situation there. States and municipalities are struggling. So we have a number of conflicting demands on the public fisc, and we're going to have to make some tough choices.
Andy, thank you for that. Well, I think it's time to draw in under this one here. As you can see, the energy sector is a sector that Quorum is really excited about. As speakers today have demonstrated, there's real opportunity, both in the traditional and new players who continually re-energize this critically important marketplace with some new technologies. With that, I'd like to thank our panelists for joining us today, and thank all of our guests for joining us as well. And that concludes the WFS webinar on M&A in the energy and clean tech sectors. Thank you all.
Thank you, Jeff.